Doesn't mean we can take the trade. It means we can put it on the list, say, yes, I'm going to look at this, I'm going to analyze this, and I'm going to watch for this to see if I can find a way to trade it. Doesn't mean you can just trade it. I'm going to show you exactly what I mean through these presentations. We've got moving averages. We've got oscillators. We've got momentum indicators. We got all this stuff, right? And you buy all these books. And trust me, I mean, tell me if you think I'm wrong, that most of the books that you buy in the bookstore are related to this. They're going to be sitting there. There might be how to trade this one indicator, right? There's whole books on one indicator. And when I say this, I'm not bashing indicators, so to speak. What I want to make sure that you are aware of, whether you're sitting here in the audience today or you're listening at home, viewing this later on, is that you understand that these are traps. If you sit here and just look at these and you just trade these are the reasons, the very reasons that we're going to lose as retail traders. And I will continue on with the thought process through the presentation, why I believe that. To carry on the thought process, so we've got trend indicators, seasonal analysis, cycle analysis, Elliott wave. Again, and with Elliott, I mean, I see it spelled with 2 T's, I see it spelled with 1 T, so I put it with 1 T now. I don't know. It could be 2 T's, 1 T, it doesn't make a difference. Elliott wave, it's good in hindsight. I use it, right? I look at Elliott wave before I make a trade, but it's not a path I would tell somebody to go down. I've looked at Elliott wave since 1997, so 11 years. And it's not a process I would tell the newbie trader to go learn Elliott wave, and that's the answer to your prayers. Your time is better spent in different areas, in the volume analysis, in looking at strength and weakness on a chart. And then GAN. GAN's something I've been doing a lot more research on in the last year. I've got some interesting stuff that I've learned. I'll show you a little bit about it later today. But I think GAN, it's really complicated. When people first look at it, they read these books, it's very esoteric. And W.D. Gann was not a very good writer. So when you read his work, you're going, what the hell does he mean? Right? You can read it 5 times. You go, well, that could mean this, it could mean that. What does he mean? And I think a lot of the stuff in Gann was hidden meanings. But there's value in every single one of these that I just went over. But there's also pitfalls. And what we want to do is make sure that you understand you can't take one of these approaches in isolation, bet your money on it, and think you have any shot of winning money over time. You got no shot doing that. It's not going to happen. I defy somebody to show me that it is happening. The only way it can happen, in my opinion, I know one hedge fund manager in England. And I did a presentation in England. We got up and he showed his system and he's looking at MACDs and stochastics. And he said he was right less than 50% of the time. But the thing that made him money is he was a master money manager, right? So he's wrong more than he's right, but he can manage his losses and, more importantly, manage his winning trades and milk every single cent out of that trade. Most retail traders will never get to that expertise level, in all honesty. You're not going to get there. Not any of you individually, just collectively as a group, we're not going to get there. We don't have the fortitude, we don't have the will, we don't have the time. You can name any adjective you want to put in there. It's just not going to happen. We want to do fun things, not sit in front of a computer our whole life. Some of us like that, though. I like to do that. Okay, here's a quote from Mr. Wyckoff. Chart keepers make good conversationalists. Chart readers make money. I really want you to think about that. And I really want to put this in a historical perspective. I started trading in 1985. There weren't really a lot of access to personal computers that had high-level charting packages on them. You had some simple stuff. I kept charts by hand. That's why I chose this little graphic on here, little pencils with chart paper. One thing I'll tell you is, since computers came about, I read a book from the 1980s, and it said, it was a trading book, and it said, with all this information at our fingertips now, the retail trader is going to be much more successful than they were without this information. And I would challenge anybody to say that's true. It's not true. We're just chart keepers. We're glorified chart keepers now. We can look at 100 charts. We can hit a space bar and next, 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 next. And we're not reading the chart, we're just looking at it. We're keeping a chart. We're not reading it. And there's a big difference. And you need to understand that. You need to understand the difference. I look at a lot of charts every day, and when you understand how to read a chart, you can read it fairly quickly as long as it's a chart that you're looking at day by day by day. If you throw a new chart at me, I'm going to take time to analyze it. I can't tell you in 5 seconds what I'm going to do, right? I got to look at it and read it. But if you keep your charts and you're trading maybe the Dow 30 stocks, you look at each of the 30 stocks every day, you can read that chart pretty quick. But if you start looking at the NASDAQ, or not the NASDAQ, the Russell 2000, every stock in there, your brain can't possibly keep up with something like that. Even if we try to look at them every day. There's probably a day in the past, it hasn't been real recent, but I was looking probably 1,000 charts a day. It's too much work, right? It's way too much work. But the reason for this is to understand, and I'll challenge you to do something just for a little bit in your life, and I think it'll help you all trade better, is if you have a market or a couple markets that you tend to center towards and trade, start taking graph paper and writing down this stuff. Graph it. Don't rely on your computer. It's a good learning process because what you're going to do is you're going to get intimately connected to that market like you can't with a computer program. Computer program is very sterile. You're going to look at it real quick and you're going to go to the next one and the next one. And you're not going to feel, you don't have the feeling really of what's going on. Well, you have to write down, but well, that volume's a lot bigger. You know, you got to measure it out on your graph paper, say, well, that should be right here. And it gets you involved with the market. And it's something that's a very good experience and an exercise, even though everybody hates to do it. I did this in 1985. And I can tell you it helped me even to this day. I don't do it anymore, but I think it's an important thing for everybody to do at some point in their life. And for anybody that's starting out now with the age of computers, you're never going to do it. Nobody's telling you to graph anything on a piece of graph paper. Are you kidding me? That's what I bought the computer for. But that very computer is stopping you from getting involved in the market you're trying to learn about, in my opinion. Okay. This is one of the most important things I'm going to tell you. I'm going to tell you methodology on how to read charts, but until you understand the obstacles in your way, in our way, as retail traders, we're never going to be able to overcome them. One of the real reasons that people are going to have a hard time making money is because of the limited approach to trading that you're going to use. And it's what we talked about in the past. Well, I read this book, I did this guy came and talked, and I liked that. It made sense to me, and that's all good, right? But this is a evolutionary process. You can't ever stop learning in this game because things are going to change. It's an ongoing changing cycle. Even though Wyckoff's approach is no different today than it was 100 years ago, the way it unfolds on a chart is different. It's different today than it was a year ago because people are doing different things. Program trading's coming in. Program trading, to be fair, messes up some of Wyckoff's approach. You have to be able to understand, well, that's program trading. It's hard to do. It's real hard to do. But when we analyze options, see, because when we do program trading, I would say I don't do program trading, I don't have that kind of money, right? I don't think any of us do. But when the program trading happens, you're going to see things in a chart that aren't real. And I'm talking specifically about like the S&Ps, the derivatives, the index derivatives. They can offload and do option trades. They can trade futures on options on futures. They can do all this stuff that's going to mess with the cash premium balance, and it's going to mess with it for a little while. And I'm not talking long. You're talking a minute, 2 minutes, 3 minutes, 5 minutes. It's going to skew this. And if you're looking and you take everything that is said about Wyckoff verbatim, this is hard. I probably can't get to the level I need to get to today to explain it, but I want to make sure that you know about it, that it's a possible obstacle. When a program trade comes in, you're going to see massive moves, right? These bars are going to go whoom, and you're going to see the volume go whoosh. And all they're doing is taking one thing over here, right? And they can do it with cash, they can do it with options, they can do it with future, and all it's deception. It's only deception. And I'm not always talking about arbitrage trading, right? Arbitrage program trading is a small part of program trading. But you need to understand that this exists. You need to understand what it looks like on a chart. And the way that I can tell you that it will unfold is it will follow through in the market. Right? It will follow through in the market. You'll see that it was program trading later on. And it's one of those things you'll never be able to say when it happens specifically, if you don't understand program trading, that it was program trading. I know I'm talking in circles now, but you need to at least get the knowledge to the degree that you can go back to the chart later on in the day and say, well, I saw that happen, and that's probably what happened, right? That was program trading. A basket went off, and it made the future, if you're following the future, it made the future do this. And that's one of the hard things about volume analysis today. It didn't exist to any kind of degree when Wyckoff was doing this. Right? It wasn't even out there. Well, it was 10 railroad stocks. I mean, they had bucket shops, right? And they'd play all kinds of things. Bucket shops would play games with individual stocks, run them up, run them down, but it's not the same as program trading today. But going back to this, limited approach and trade analysis, we got to be real careful of this. If we can't truly analyze strength on a chart and weakness on a chart from the major players in the market, right, the consensus of players, we collectively as retail traders, very small amount of the overall volume in anything, right? Program. Professional traders never sleep. And I know in the past I've made that statement, and I had people email me and said, well, yeah, they do. Yeah, on this day they're in bed. Yeah, well, they might be in bed in America, right? But there's different time zones people trade in. This stuff never goes to sleep. The only time it go to sleep is when nobody's trading it, right? It was a holiday, then nobody's trading it, but they're probably figuring out what they're going to do when the market opens back up. You got to believe that. And I'm going to really give you some ideas on this limited approach and trading analysis. I want to hammer that point home a little further in a couple minutes. This is another really big stumbling block for every trader at some point in their career. And I mean everybody, is this trading psychology and self-psychology skills. I'm going to run you through an approach here, if you will. I'm going to show you how the way that we choose to trade as retail traders actually creates psychology problems or exacerbates them. I think they are created, part of them, from the time we're little kids. You know, I want you to think about this and internalize this. When you were a little kid, whoever you would go shopping with, unless you were born in the Rockefeller family or the Buffett family, it probably didn't matter, but you know, when did your parents buy things? Generally speaking, they'd wait till they went on sale. So we have this mentality from the time we're a kid. Well, I want to buy it when it's on sale. I don't want to buy it when it costs more today. I want to buy it when it goes down tomorrow. And I've got a friend that I'm teaching how to trade right now, and he keeps trying to grab these things as they're falling. They're falling, they're falling. I tell him, you're trying to catch a falling knife. I mean, it's going to be very hard to do. You don't know when the bottom is. Let's not pick the bottom. Let's let the professionals come in and say, we're going to support this price now. When they come in and support the price, then we want to get interested in it. We don't want to look at things on sale. Don't want to be a value shopper. Warren Buffett does a great job at it. But we're not Warren Buffett. I'm not. I can't teach anybody how to do that. But I can tell you that we're going to become successful when we can mirror the professional interests that are out there that want that thing to go up. Once they've proven that it's going to go up, that they're buying it, that's when we want to start to look at it. We don't want to, jump in front of the professionals. We'll get run over. But I'll go through an example I think that's going to help you understand that if it's not totally clear right now what I'm talking about. And here's the other thing that I find in dealing with a lot of retail traders is, what's money management? What are you even talking about? Oh yeah, no, I risk 2% of my trade. That's my money, or 2% of my account. That's my money management. My God, it's a lot deeper than that. And you need to understand that. That's probably the biggest key, assuming we have an approach. It's arguable that you could take a professional trader and just say, heads or tails, you're going long or short. And within a few minutes or whatever time frame they trade on, a few days, they're going to say, okay, I took the wrong way, I'm going the other way, and they'll start making money. Retail traders, though, don't have that skill, right? It's a learned skill. Somebody can show it to you. I'm going to show you today how I do things. I hope it helps you, but you probably can't do what I do because we have these little demons on us, on one on each shoulder. Fear and greed, whispering in your ear. And they're at you as you're watching that ticker. Right? A little ticker's going up and down, up and down. And it might not even be that you're day trading. You could come home from work and you're swing trading. And all of a sudden, oh my God, I'm doing good. That bar went up. And the next day you come home, ooh, I don't like that. If I was long, I'm starting to get worried. And then that worry starts playing on you. You know, it's inside your mind. And professional traders know this. They can move price bars around to their advantage. They've got the money to do it. They do it. It's a fact. And I know it's hard to understand. People say, well, there's not enough, nobody has enough money to move the market. Last year I came in and I gave an example of Jim Cramer from Mad Money. And he was telling exactly how he moved prices around. It didn't take much money. He said $20 million. $20 million pre-market, and he would create an illusion. That's what he called it. He'd create this illusion to make people believe, and the people he's making believe isn't other professionals. He's making retail traders believe something that's not real. So he can take the other side of the trade and make money from it. And it happens every day. Okay, number one, the reason this chart's up on the screen is most retail traders have a long focus. Everybody wants to go long. You tell them, look, but you don't have to go long. You can sell something you don't own and make money from it. And if you've never heard that before, you go, what? Say that again? And it's hard to conceptualize selling something you don't own. Nobody does that in real life, really. I mean, John Q. Public and Jane Q. Public in real life, they don't go out, well, I'll buy this car later, but I'll sell it to you now. No, I mean, that doesn't happen. So people can't conceptualize that. So there's a long bias from retail traders to start with. And with that bias, you've got these traders using canned lagging indicators. Most all of those indicators I showed you when we talked about technical analysis are lagging. Right? They're going to lag. That's going to be a problem. That's going to create and exacerbate the psychological problems that we're going to start encountering in our own mind. And watch how this happens. So we use these lagging indicators. And we start getting into the trades too late. We see the setup. We start chasing trades because these indicators are now just firing off. We have this long bias. So I'm going to use a long example. Market's going up. All of a sudden, whatever indicator you're using says buy. And the bottom that was down here where the professionals were driving this price up from, as an example, now you're up here. And your indicators went off. You say, ooh, time to get long. Hey, and you might be in an uptrend, right? But when we're taking this trade, we have a hard time managing the position. So we're going to get in this trade too late, which is going to create losers because you're going to buy at the top of the market. That's what happens to the mass public. It's called the herd mentality. I'm going to tell you about that in a second. The mass public buys at the top. The mass public sells at the bottom. The reason for this is your minds are being manipulated in the press. Your minds are being manipulated from the indicators that are generally being used by the average retail trader. Not that anybody in here is average, right? None of you guys are doing this. But people in America and in the world that trade as retail traders all do this. So our losses run, but now all of a sudden we take that trade, and we were right. My God, I got money now. What are you going to do? You're going to take the money now because all the other times you lost money. So now you got the winning trade, and now you want the money in the thing that's going to move up and make a lot of that money back that you lost on your other trades that you let run too long and the losses were too big. Now you've got a winner, but now we're fearful that profit's going to go away, right? And now we got to take it. This is innately in our minds. It's drilled in our minds over and over because of the way that the retail trader trades and the way the professional trader manipulates the retail trader's mind. We better take that profit now because at least I got one. It's the wrong way to think. When you got a profit, you've got to milk that thing for everything that it's worth. I'm going to show you an example in the third presentation today about managing a trade, exactly how you do that. Exactly how you do it. So we've taken the trades too late. we get losses right away because we're in late. We finally get a profit on some of our trades. We cut them short because at least we got a profit. What are we trading with now? Trading with fear and greed. Fear and greed dictate the decisions that we make. We can't let that happen. But it's easy to say, and I will tell you from 1985 up until the late 90s, I struggled with this mightily. I struggled with this immensely. And I don't think anybody can, I can tell you it's going to happen and it's happening to you right now, but I don't know that anybody can go fix it. I know that Ron's been through some hypnosis and it's helped him immensely, but even that was a year-long process, right? And it's experience, right? I can tell you, don't let that happen. And I'll tell my friend, I look at a chart and I go, take some money off the table. He goes, what? No, it's going up. I said, well, it's good. It's good to go up. But take some of it now in case it doesn't, right? We'll bank a little bit of the money now so we've got it in case the trade goes against us. Okay, I'll do that. I talk to him next week. I go, what happened with that stock? I see it way down. He goes, oh, I'm losing money now. And I'm going, no, you can't let that happen, right? But it's easy to tell you, and it's only experience of going through the individual pain that's going to allow you to get through it. I don't know any other way. That's the only way that I learned, is it happens to you 100 times, and it's like kicking you in the head. I mean, finally, it's going to start to hurt, and you're going to say, okay, I got to do something about it. Something's got to change. But I think the way we're wired from childhood has a lot to do with why we can't change it. And that's where trading coaches can come in and help you. That's where possibly hypnosis. I've never tried that. But yeah, it took me, I think, 11 years, 12 years of just hitting my head against the wall until I finally got it. But I'll let some of that rub off on you just through the process today of saying, here's one trade example. Here's how we would trade it to make sure that doesn't happen to me. And if you can just apply it, keep watching the video that I put that on, apply it in your everyday trading. Don't let winners become losers. It's one of the biggest problems, is people let winners become losers because of fear and greed. And here's the biggest problem with inexperienced new traders and losing traders is we don't know how to handle uncertainty, especially scientists, doctors, engineers. You know, an artist doesn't have a problem with this. Artists make pretty good traders in general because they don't live in these rule-set boundaries that it has to be this, this, and this way for this to happen. But doctors, scientists, engineers, I mean, you learn a certain way of life, and this is the way it has to be. And they're some of the most intelligent people in the world. But when it comes down to making that transition to trading, they're bound by these rules, and then these rules don't necessarily all work because there's uncertainty there, and how do you handle uncertainty? And it's hard. It's difficult. But these are some of the traps that are in front of us, right? And then this is one of the biggest ones for retail traders, is we trade with this herd mentality. And I just need to make sure you understand what the herd mentality is to understand how to not be part of it. To not be part of the herd is being contrarian by its very nature. You don't want to do what John Q. Public's doing. Everybody in your block buying a brand new Cadillac Escalade, maybe with gas price at $4 a gallon, you don't want to buy a Cadillac Escalade, right? Don't go by and say this, do the same thing. But we're driven, again, from little kids. We've got to fit in. We've got to conform. So we're groomed to be part of this herd mentality from the time we're born. And to get out of it is really hard, really difficult. But here's what it is. That's what happens when we go down this path, is we fall down this never-ending slide. It gets worse and worse. It can get so bad for people, you read stories about this, that they can't even push the button to make the trade anymore. They go and see psychiatrists and psychologists because it messes your mind up. Because we're all relatively intelligent people. Some are more than others. I don't think there's anybody that can't trade, right? But when we keep having these things hit us as people and we keep sliding down, it becomes harder and harder and harder. We start looking harder and harder and harder. And a few % of us will find the way. But the vast majority are just going to keep going down, and it's almost a never-ending road. And I make that sound like, why in the hell are anybody in here today, right? Go enjoy your Saturday. But why mess with this? But it's something that drives us all, isn't it? I mean, we can see that there's a way to make money in a market. We just got to find the way. But I think one of the real keys to finding that way is to know what lies in front of you first. So that when it happens, you can say, I expect this. There is a way through this. It takes time. I think most of this is finding the right thing, analysis-wise, to do, going through enough experience through that pain to actually understand, see what you're seeing, feel the pain, and then start modifying your behavior to stop it from happening. And that just takes time. I don't think anybody can tell you in a week seminar or a 2-day seminar on trading psychology that you're going to come out tomorrow, you'll be different. It's a process that we all got to work through. I was watching the Animal Network, Animal Planet, I think it's called, as I was putting this presentation together. I was thinking, what do I want to tell this group? When I get here and this thing on herd mentality, I knew I had to talk about it, but I guess there's a problem with the Cape Buffalo population in South Africa. I didn't catch the whole thing. I think they're trying to weed out some of the bad herd from the Cape Buffalo, and in doing that, because if they don't do it, the Cape Buffalo is said to be going extinct. And they don't want the whole species to go extinct. So this famous hunter, it's a pretty cool name for a guy that's a hunter, Lindsey Hunt, right? It's like Todd Trade. But, you know, Lindsey Hunt is an expert hunter, and he said, okay, well, the one thing that we know that can help us, because they were interviewing and said, well, this is going to be extremely hard to do to save this population. And Lindsey Hunt said, yes, but the Cape Buffalo is a highly social animal driven by herd instinct. I want to drive that home to what it means to us, right? Here's my definition of herd instinct. When you apply a known stimulus to a herd, you get a highly predictable response. Let's put it to market terms now. If a professional wants to distribute, call it a stock for right now, it could be a future, it can be anything. Let's call it a position even. Professional bought it at wholesale levels in the inventory process, and they want to drive it up now to sell it to the retail trader. The stimulus that they're going to apply to the herd being the retail trader, is we're going to jack the price. We're going to run that price up and create activity that the retail public starts to notice, that the media starts to pick up on and starts to talk about. It starts being hit on in newspapers. Maria Bartiromo from CNBC starts talking about it. It becomes public. The public, being the herd, starts to buy. They do the very thing the professional trader wants them to do, is to take their position from them. That's how we're individually driven as a herd in this game. Right? It's no different than the Cape Buffalo. It's the same thing, except the professional money knows how to stimulate us into doing certain things, and they will get a highly predictable response every time. If they want to buy something, they'll run the price down until you sold it to them. I'll show you what it looks like on a chart. I mean, we're all going to reach a point of pain. Even though we keep our losses too long, there's going to be a point where you say, my God, I'm out. And that point when you're out is the point when they're getting in, right? And the inventory process is changing now. Here's a typical retail trader's chart. And I'm going to describe this, and then we're going to change tapes and start going again. So typical retail trader's chart. Number one, there's no volume. Right? We've got no volume on this chart. We've got a stochastic. We've got a MACD. This is the reason I use this, is what the hedge fund manager in England showed on his chart. And he had RSI through RSI in there too. But there's nothing about volume in there. Right? We put a moving average on because a lot of people like to put a moving average on. And that is the SPDR daily contract. SPDR daily contract. So that's the average retail trader. We're using lagging indicators. What we're going to do is try to maybe use 2 or 3 together. We're going to create our own customized system. And we're going to make this stuff try to make sense to us as individuals. And we're going to stop for this. We're going to reload the tape, and then we're going to go forward, and I'm going to show you some pitfalls with this.